Thank you to all of those logging on to Money Show's virtual event. We do have about 3.5 minutes before the next session begins. So sit back, we'll be right back with you. You do have a chat box next to your video player. Feel free to type in any questions as we go. Time permitting, we'll try to have a couple of those questions answered. So thanks for being here. We'll be back with you in about 3 minutes. All right, Gregory, we are about a minute and a half out. I will lead us off with a quick intro and we'll be ready to go.
Sounds good. Can you still hear me? Good.
Audio sounds great.
All right, great.
All right, everyone, welcome back to Money Show's virtual event. We are pleased to welcome Gregory Farinello, head of U.S. Rates Amerivet Securities. He has over 25 years of experience in the financial service industry, which has been centered around fixed income with a core expertise in trading, distribution, and business development of global interest rates. Prior to working at Amerivet, so he served as head of rates for Robertson Ryan Investment. His career began as a fixed income derivative analyst with Credit Suisse, Merrill Lynch, and Goldman Sachs. He then moved to the buy side as an assistant portfolio manager on the international bond desk with Deutsche Bank Asset Management. In a move back to the sell side, he filled leadership roles as managing director and FICC management member and as head trader and risk manager responsible for the build out and development of several trading desks. He attended the U.S. Military Academy at West Point and later earned his bachelor's and master's degree in business administration from Hofstra University in banking, finance, and international business. A CFA charter holder and member of CFA Institute, NYSSA, Money Marketeers of New York University, and has served as the Dean's Advisory Board of Hofstra's University Zarb School since 2012. He's registered with his FINRA Series 7 and 63. Gregory, thank you so much for being here. It's all yours.
Mark, thank you very much. And thank you. We've been trying to do this for a while. And, thank you to the entire team at the Money Show. I love what you guys do. And I'm glad we finally hooked up. The title of our presentation right now is a new Fed regime in general. And, it's interesting as you go back to my entire history. I would say right now, there are some similarities to what I've seen, and I've seen a lot. And we've seen a lot of pockets of time which have been extremely tricky. And this is certainly one of those pockets of time. There are certain similarities to what I've seen in the past. And there are certain things I think moving forward that are slightly different. And the slightly different is somewhat unpredictable. So I appreciate you guys having me on today. I mean, it's an interesting day in general when you look at markets, when you wake up and see these dynamics. I think now, the geopolitical side obviously is certainly front and center, and you can't really predict how that's going to go day to day or night to night. So, we're all living through the same dynamics right now, and they are different. There's absolutely no question about it. So, I want to kick off with the change in Fed regime in general. New Fed Chair Kevin Warsh. Uh, he had his first Fed meeting. We got the Fed meeting out of the way. We have the minutes out there as well today. Certainly, I think the Fed they're a little conflicted on the overall environment, and the confliction is really it's really not around employment. I think the employment market is fairly good. It's not great, but it's fairly good. But the one big difference that we do have right now, I think, is on the inflation side. If you look at the official inflation rates, I think I think under this new Fed chair, we're going to fine tune a couple of things. We're going to fine tune how we look at inflation officially. And then in terms of forward guidance, that's a one big change. So RIP to Chairman Greenspan. I grew up in the heyday of my trading days with him. There was no forward guidance. I mean, a colleague of mine and I joked about this. He used to walk out with the briefcase and that was it. So I think we're moving back to those days where you're gonna get a lot less forward guidance. If you look at the quarterly projections of what the Fed puts out there, you look at the dot plot. Uh, Chairman Warsh, he decided not to put his dot there, and I think that's a statement. So I think we will get much less forward guidance going forward. On the regional bank side, there will likely be less communication. But personally, for me, I think the regional bank heads are very important because I think they sit in their districts. And when you look at the economy, to me, that's an important thing. It's important to get some feedback. Now, how they communicate that feedback, I think, remains to be seen. But I think the new chairman wants to see less communication overall, which certainly could create some volatility in the marketplace. Um, Chairman Warsh's style. He's he's not a dove. I mean, I said this from the start. He seems very committed to, the Fed's 2% inflation target, which I mean, for me, I'm a little questionable about. I mean, it's just a number in the end. Certainly, you can't let inflation expectations get away from us. But if you look at market-based inflation expectations, they're very well contained. So, how he presented, in my view, from the start, is is appropriate, and it is slightly hawkish, but in the end, we don't see, although the market is pricing in rate hikes here, we don't see a July rate hike coming. We don't think higher rates are necessary here for the economy. If anything, we see it a little bit the other way. In terms of the formal outlook moving forward on rates, Treasury rates have moved certainly higher here. There's no question about it. 10-year yields in at around 4.56 right now. Global rates have moved a little bit higher. and we certainly could move. We could move either way from where we are right now, depending on circumstances. You know, the challenge with Treasury rates right now is we in the United States we do have good policy in place, and I am committed that the economy is still in a good place, and uh, right now we have growth that is looking fairly decent, and at the same time we have inflation that's elevated. So it's going to be really, I think, hard for rates to come down meaningfully from here. They have come down, they've gone back up. You know, we're sort of waffling around here, and that's not necessarily a bad thing. But in the end, I think that's kind of where we're at. We are, when you look at the global stage right now, if you look at what's going on globally, when you look at what's going on in Japan, when you look at what's going on in Europe, and then you look at what's going on in the US, you know, we are in a fairly decent place right now relative to the global stage. And when you look at rates and you look at economies overall, it's all relative right now. I mean, we're not, from a central bank perspective, we're not all towing in the same direction. But when you look at the economies around the globe, we are disconnected. There's no question about it. Policy is disconnected. If you look at the US rate structure in general, yes, we are higher than most. I mean, currency comes into play there too. But the reality is, we are, in my view, in the best position of many of these global economies, and I think it will remain that way. It's not to say there's not going to be volatility in place. Normalized rate structure. So it's a normalized rate structure in the United States, in my view, is a good thing. It's not a bad thing, because when when you look at risk assets across the board, you look at options of, you know, where you can deploy your money and where you can't. You look at days like we're having today, where risk assets are down. You know, you see an environment where you want places to go with your money. And the fact that the US rate market has normalized, I think is actually a good thing. So I, I don't I don't think we need to force this. I don't think we will force this. Fed Governor Waller has has spoken recently, saying that, you know, he actually thinks less forward guidance is good. I agree with that notion, but if you have the ability to move capital in and out of risk into risk free, and I still, uh, the treasury market has changed a little bit, and you know, we certainly have some issues, I think, on the issuance side. But when you look at the rate structure right now, we still believe that a lower rate structure is needed here for certain dynamics, and I'll get into that a little bit. But a normalized rate structure in the U.S. Is not a bad thing. So, what does that mean for the economy? In terms of what I see right now, and I can point to, I mean, you have to point to every aspect of the economy, but if you look at if you look at the main components of what we're doing, I believe we are in a counterintuitive cycle here. Whereas normally you'd want higher rates to slow things down, we don't want to see this economy go into a recession by any stretch. but I actually think lower rates are necessary. I'm not saying we're going to get them, but when I look at the rate pricing structure in general, I don't see rate hikes as the answer here. And I'm not suggesting that the Fed is going to lower rates anytime soon. I don't think that's going to be the case. But in the end, even if you look at like simple things, right? If you look at housing in particular, uh, it's it's a it's a supply side dynamic, and so how do you loosen the supply? You loosen the supply with, it could be fiscally, and the president has certainly spoken about that and some changes that that ultimately is only going to go so far. What goes so far are lower interest rates where people can finance and get out of mortgages that the Fed bought through the pandemic and they own on their balance sheet, and people are locked in at lower interest rates. So, we in general we need lower interest rates. If you look at even simple things like car leases, they've come down. They've come down because of a reason. And so my view is, and look, it may be a view that people don't like or don't agree with, but we've been writing to our clients now for a long period of time that we need lower rates, not higher rates. And so I think new Fed Chair Warsh is going to be cognizant of that. It's not entirely clear how he handles it, but we don't see formal interest rates going higher as the answer. And then ultimately, if formal rates from the Fed uh, don't go higher, and we start to price out some of the tightening that's in the marketplace right now, then it's all a derivation. I mean, I can't really speak to the very long end of the U.S. Treasury curve, but certainly on the short end and certainly out through 10-year space, if the Fed tempers things down here a little bit, which we expect them to do, then you're going to see, you should see rates, come down a little bit from here. Um, on the geopolitical side, it's it's really day by day is how we see it, and ultimately, I think investors need to know that this will work itself out. It's not going to be an easy process by any stretch. I don't believe the president wants to have something prolonged here, but once you dip your toe in the water, you're in it. So we're in it right now. Today was, it's a difficult day and a difficult night overnight, but ultimately, I think the this is not going to be some prolonged strategy. I think they will ultimately, find a way to work through this. It's a difficult scenario right now for markets, but when you look at markets in general, they've done they've done very well, all things considered, and we expect that to be the case. I mean, volatility, I think, has been low in general. So when you're at low periods of volatility, you have to expect, especially within a pocket of time like this, that things are going to be a little choppy, and that's what we've had. From our perspective at Amerivet, from an issuer and investor perspective, it has not been a bad environment at all. On the investor side, they love yield back up. Credit spreads in general they've been relatively low. We could move higher. Volatility has been low. We could move higher. On an issuer perspective, it's been opportunistic, but they've been coming to the market. So it goes back to a more normalized rate structure over time, and one that, I believe from an investor perspective, I think it's a complete no-brainer because we have a normalized rate structure. From an issuer perspective, they've been accustomed to a higher rate environment here, and they're still coming to market. Balance sheets are in really, really good shape. The biggest, I would say, the biggest challenge we have right now is, US, when you look at corporates, I mean, they can manage their businesses internally through how they're set up corporately, who's in charge, and how they manage that from a corporate and C-suite level. But when you look at the U.S. government in general, that becomes the biggest challenge because we have politics that come into play, and we have a lot of debt outstanding. I mean, that is just the reality of it. And if you look at that trajectory over time, it does not appear to me that that's coming down anytime soon. So when you start refinancing that at higher levels of interest rates, it does become somewhat concerning. Are we there yet? I don't think so. Can we get there? We could, certainly. And so we're colliding a little bit here. The biggest the biggest thing that has come out of this debt cycle is inflation in the end. And that's really going to be the challenge because rates are not necessarily going to come down a lot. At the same time, we have an endeavor, I think, globally, not just here in the US, where even in Europe now, where you've got defense spending and the need to potentially uh, issue more and expense more, and that's where we're at. So, and in the United States, I mean, I think we're probably in a better position than most, but still, we have higher rates now, which uh, I think is not necessarily a bad thing. But if we're going to continue to grow our debt over time, that could be problematic in terms of what that means for the bottom line, what that means for the government, and also ultimately what that means for the consumers. So it's we're in an interesting pocket of time. It's not going to shed itself, I think, really short term. But the longer we sort of sit here, the longer we continue to um, need to issue debt and continue to grow our debt with higher interest rates, I think that does potentially become problematic. Now, the administration and Secretary Bessent has done, I think, a great job, a fantastic job. And the goal and the desire to get rates lower is real, and I agree with that. But markets behave the way they behave, and that's it. Even when you look at energy prices across the board, I mean, today we're up, we've been down. I mean, we've been of the camp that energy prices, if anything, were going to be lower, not higher. We got that right, but we don't always get it right. And uh, certainly there are a lot of people saying we were going a lot higher. So there's plenty of energy on the market right now, I think. And so yeah, we're just in a very tricky pocket of time. In terms of assets in general, risk assets. I mean, the AI story is going to continue to evolve. There's no question about that. We're going to have ups, we're going to have downs, we're going to figure it out. We're in one of those phases where I think it's um, you got to learn as you move forward. My view on, I'm constructive still on credit in general because we're constructive on the economy. And I still think, as long as the labor market holds in here, I think we're still in relatively good shape. We're not creating a ton of jobs, but we are still creating jobs. And I've seen a far worse scenario than where we are right now. And, we talk about this 2% target, and new Fed Chair Warsh has talked about this 2% target. But if you ultimately want to pursue this 2% target to the end, you're going to put the economy in a recession. There's not a question in my mind. And so how he fine tunes that, I think, is important. It's important for everyone, but in general, we still think the economy is in good shape. And the labor market has weakened, but the bar to keep that unemployment rate low has certainly come down. I think the I think the Fed is cognizant of that. And so it doesn't mean they need to tighten at all. It doesn't mean they need to ease at all. Maybe it just needs they just sit on their hands and leave things alone. If you look at official rates, forget about treasury rates. I mean, treasury rates are certainly a function of the Fed's official rates, uh, depending on where you look on the yield curve. But the reality is, if you look at official rates over time from the Fed, we're calibrated pretty good here. And New York Fed President Williams yesterday, uh, he he was pretty clear. He said, "I think we're well calibrated," and he's eh, eh, he's been uh, not maybe on the hawkish side, but I think a little practical. But I think he's right. I mean, if they need to ease more from here, they can. In terms of tightening and market pricing, though, when the Fed shifts gears, generally it's not just one rate hike. So if you look at where the market is priced right now, and that's the conflicting thing. I mean, we've skewed from rate cuts to rate hikes, and we get a lot of call from clients about this. What's really changed? So certainly short-term inflation elevated, which we spoke about. But typically when the Fed, like, one rate hike here is not going to make a difference. If anything, it can be very disruptive. And, you know, when they typically go much more than once. So, it doesn't have to be 5 times, but, it certainly could be 2 to 3 times. And, I just don't think that's the answer for the economy right now. So, in terms of treasury rates, we're going to gyrate, I think, around. We're going to gyrate around where the economy goes, and I, I personally, for me, I don't think there's anything inappropriate about the rate structure here. I don't want to see rates go much higher from here, but in general, when I look at where formal inflation rates are, when I look at where growth is at, which we all want the economy to grow and do well, I don't see anything terribly inappropriate right now. So I'm going to end on that, Mark.
All right, Gregory, thank you so much. Great presentation, very informative. We had a question come in from one of our attendees. They're saying it appears that the escalation in Iran is restarting up again, and oil starting to rise back up. How do you think the new Fed regime may react to this?
So that's a great question. I if you look at oil prices right now, I mean, we're well off the highs. I mean, my view is nothing. I mean, they don't need to do anything. I mean, it's, if we were at $150 a barrel in WTI crude, I'd say maybe we have a problem here. But, we're at 73. We've been bouncing around. We're well off the highs. This recent escalation to me is not problematic to the Fed. If they react to that, uh, I think it would be a mistake, in my view. And I don't think they'll react to that. You know, the Fed is not in the business of reacting day to day. Markets are, but the Fed is not. So I think new chair Kevin Warsh is, I think he's got a level head. He's got a committee. There's no question about it to deal with. So, and I think he'll get through that process. But I don't see the Fed reacting to this new escalation unless things get unless things go the other way in terms of energy prices, which when I look at markets today, I mean, we're up, but we're still well below where we were at our peak. And I think, the interesting thing is markets have a great ability to adjust and adapt. So you get through over time, you get through these periods where things kind of peak and they peak for a reason. And then you normalize a little bit and then you chop around. So that's my view. I'm not really concerned about what we got overnight.
All right, thank you so much for that. Another question came in. How important are foreign buyers to the future of the Treasury market?
Important. I mean, there's no question about it. Uh, so the it's a complicated question because a number of years ago, we wrote to our clients that ultimately, as interest rates in the U.S. go higher, the the buyers of our debt will be domestic, and that's turned out to be the case. Do I think foreign buyers are important? I do. China, they've downsized. Japan is in there, so I, I think it's important uh, over time. And if we continue to grow our debt, then in some crazy way and shape and form, higher rates in the U.S. are necessary because we want our own people to buy our money. And but foreign buyers are definitely important. They're always going to play a part in this role that we have right now. Um, we have different venues, and the government can get creative, but I think foreign buyers are definitely important. And it becomes a matter of capital flows too. I mean, countries need to find ways and places to put their money. So I think water finds equilibrium over time. We're shifting right now. The foreign buyers are definitely important, but domestic buyers are definitely important as well. And that can include regulatory stuff too, because there are a lot of entities in the US that utilize US treasuries for different purposes. And if we clamp down on that from a regulatory perspective, that can become an issue. So we need to be very thoughtful. I think we have a great Treasury Secretary. He's very well attuned to the global marketplace in general. He understands Japan very well. He understands currency very well, like I do. And, I think it's going to be okay. But, the foreign buyers I think they're always going to be there. But they are important for sure.
All right, Gregory, we have time for one quick question. What economic indicator would make you change your outlook most quickly?
The ISM numbers in general. I mean, well, okay, I'll be quick on this. Two things. I mean, if the employment picture turns negative, that's a game changer. In conjunction with that, the ISM numbers are important, not necessarily manufacturing, but services. So we're and the claims numbers too, the jobless claims numbers, which have held up, which tells me that the job market is still in pretty good shape. Job market is first and foremost. The ISM numbers are low 50s. I mean, at the peak, we're in the high 80s. So the economy is doing okay. It's treading water. So I would keep an eye on employment. I would keep an eye on the claims numbers in general, continuing claims, which we've been a Bible of for a long, long period of time. And then the ISM numbers. Everything is sort of coming together like things are okay right now. But I would use it's not one particular number, but I would use all of those three in conjunction.
All right, Gregory. Well, thank you so much for joining us today. Greatly appreciate it. Let's do it again soon.
Mark, thank you so much. And thank
All
you for
right.
your audience.
Absolutely. Thank you for the questions out there. We are speaking with Gregory Farinello, head of U.S. Rates AmeriVet Securities. You're watching Money Show's Virtual Expo. Stick around. We have more great content to close out the day and a full day tomorrow. So be sure to check that out. We'll be right back with you.